Well, despite lower than expected data on manufacturing and housing that came out this morning, the market started with oomph, and we never looked back. All the things that have tied investors' stomachs and knots, however, they're still lingering. We're talking about geopolitical on the military side, geopolitical on the economic side, Trump's economic agenda and its timeline, and the slowing U.S. economy. Now, on the Trump economic agenda, there continues to be some scuttlebutt about behind-the-scenes negotiations within the GOP, and it's creating a general sense of cautious optimism. For the most part, though, today's rally was a sort of a sigh of relief rally over that dud missile that fizzled on the launching pad, and no nuke test, no nuke bomb test in North Korea. The other factors were traders. Remember, these traders, for the most part, went into the weekend, a three-day weekend, with cash. They started to buy that dip. While this weak economic data might be good news with respect to the Fed not hiking rates, I'm going to tell you from my perspective, I find it odd, though, that financials were the strongest performers of the session. Now, it's true, regional banks and some bottom fishing helped. Remember, M&T Bank had a great number before the morning, one of the best upside surprises they've ever had. In the meantime, also, technology stocks. They act great, and after the close, Netflix, you can see, turned it around. It was initially down after the results. That stock is trading higher. Now, the good news is that the S&P 500, every single sector, all 11 of them were in the green. That's great. The bad news, though, is it came on very, very light volume, and all of those concerns, all of those things that had us in knots, they continue to linger. Now, tomorrow, President Trump will visit Snap-on Tools in Milwaukee, Wisconsin, highlighting that this is an all-American business. I think it's a great sign for investors wondering what American stocks add to the portfolio. This is one of my favorite names in the group. I would be a big buyer of the stock. Now, it's extremely oversold, and I think it could double in the next 2 years. I've got details on it at wstreet.com. Joining me now to discuss, Heather Zumarrago. I think I got it right.
Yes, you did. Yes,
All right,
sir.
well, welcome to the show.
Charles. Good to be here.
All right, so let's talk about this. The Trump rally is starting to struggle a little bit. You know, the first 5 months we set, the first 5 weeks rather, we set all kinds of records post-election. More recently now, since the inauguration, we're just starting to stumble here a little bit, and a lot of people are pointing, of course, to that failed health care rollout, the Obamacare repeal.
Health care meaning we might not get tax reform, and that's what the markets are waiting for. The markets are in the show-me state. They want to see tax reform because we're near all-time highs, and we want to see that occur so that the markets can move higher. As in, what's the next catalyst? You know, we've had earnings come out, double-digit earnings growth thus far. Revenue growth is pretty strong. But I'd like to see participation out of other sectors, such as energy and the retail sector, like the consumer, not just the financials as of late.
But retail, I mean, all of these brick-and-mortar retailers gone out of business. Can Amazon and things like Carnival Cruise Lines be the new way of taking the pulse of consumers rather than the earnings at you know, one of these brick and mortar?
Yeah,
places?
But it's putting everyone else out of business. We've had 9 major retail bankruptcies so far this year. Over 9. I mean, that's a lot. There are simply people are shopping online, the Amazon effect. We built way too many malls, and we're spending more money in bars and restaurants than we are at the grocery store. I know you're probably out eating.
Don't look at me. Don't look at me.
So that's what's going on with the consumer. And we're not buying material items like clothes. We're shifting towards restaurants.
Ultimately, the market moves on earnings, right?
Yeah.
If we get a strong earnings report, because the indications are right now, the street's looking for over 9%, perhaps a whisper number is 12%. Would that be a good enough catalyst to at least justify where the rally has been in your mind?
It could justify where the rally's been, but I want to know what the next catalyst is. And with the data softening, such as GDP, jobs, unemployment data looks okay, but if you dig a little deeper, the numbers of wage growth slowly improving, but not where you want it, as well as the participation rate. I need to see those things improve. And couple that with worries that the Fed may unwind their $4.5 trillion balance sheet. The market may not be priced for that.
Yeah, the market, I think, to your point, when that news came out, was a little taken aback.
Paper tantrum.
Yeah. All right, Heather, thank you very much.